Hello and welcome to this session. Lending and financial health will always be at odds. Loans, funding and credit offer much needed liquidity to businesses and personal accounts. These injections of capital also create debt, which can often mushroom to unhealthy levels. Is it possible to balance cheap access to credit and loans with financial prudence? Well, this is the question we're here to discuss and explore, and I'm delighted today to be joined by two experts on this. We have Stephen Peacock from Think Money and Philip Haglund from Gimi. Now, I'm going to ask the two delegates to introduce themselves in just a moment. But before I do so, it's a pleasure to welcome here. My name is Brabyn. I'm an ecosystem and innovation specialist, and I'm delighted to welcome you here today. So if I can turn to each of you gentlemen, first of all, Stephen, could you introduce yourself and Think Money, please?
Yeah, hello everybody. I'm Steve Peacock. I'm the Chief Risk Officer for Think Money. Think Money is a fintech business based in Manchester, and we provide effectively a current accounts for those customers who are underserved by pretty much the mainstream banks. And we're very much helping sort of those that are what you call financially vulnerable. So helping them manage their finances, help them budget, and also help them sort of repair their credit rating and assessment as part of that process is one of the byproducts of it. And then what we also do is we offer a range of products on a brokered basis, which provides better choice and better value for money to customers as well.
Thank you very much, Stephen. And Philip, welcome. You're from Gimi. Can you tell us a little about yourself and Gimi as well?
Yeah, absolutely. Thanks for having me. My name is Philip Haglund. I'm CEO and founder of Gimi. Actually, former football player. So for the most part of my life, I've actually been playing football. At the age of 25, which is 8 years ago, I started working with a project called Gimi. And Gimi is about including children in the financial landscape and making sure that they have access to financial tools. So today we're one of the world's most used pocket money apps. And what we're actually trying to do is to make sure that we teach the next generation about like managing their own money and making sure that they can, as they grow up, so they can tackle all their like financial challenges which they might have as grown-ups.
Great. Well, thank you both very much indeed for your introductions. Now, in a minute, we're going to turn to the challenging questions of debt and the financial models of major players in financial services industry. But just before we do, just to establish the baseline for each of you, I'm going to ask you a rather personal question. I'm going to ask you how you and your business make money. And the reason I'm going to do that, of course, is because some of the financial models that fintech organizations use are coming in for some scrutiny. So it'd be really useful just to have, as a start line, an idea of the models that you yourselves are associated with. So, Stephen, can I ask you to just answer that question to begin with?
Yeah, sure. No problem, Ben. I mean, what we do at Think Money is we as I say, we offer a current account and we charge a fee for the current account. So we don't offer free banking as I guess most people would understand it, whereby you open an account and you don't see a fee every month. We do. We offer a fee every month. And there's two accounts that we offer. We offer effectively a basic entry account for £10 a month, which just helps with customers with budgeting and how they manage their finances. And that's the only fee they get. There's no other bank charges associated with that. And then we offer a current account plus, we call it, which is £15, which does exactly the same thing as the sort of the entry level account. But what it does there is we package up a number of other benefits that we believe our customers, through our interaction with them, really need help with. So it's value for money in terms of like where they might do their shopping and various things like that. So we're very much there trying to provide that value for money service to our customers, recognizing that the customers we tend to have are more financially disadvantaged than, say, the mainstream customers in banks. And that's how we do it. We used to, up until recently, have our own lending book, and we used to lend to our own customers. But we very much took a view that, one, because of the rates that we were having to charge were high and fairly punitive, and we didn't like that and didn't sit well with our culture and our ethos as an organisation. So we've moved away from that and ceased lending. And what we've done is we think it's better to have a marketplace where we can have a range of providers that do lending, energy switching, all those types of things that provide better value for money to our customers. So we're very much on a financial inclusion journey is very much what we're all about at Think Money. So again, we differ, as I say, to the mainstream banks in that that's our main income from the fees that we charge in our current accounts.
Stephen, thanks very much. And Philip, same question to you. How does Gimi generate revenue?
So what Gimi is doing and what we're focusing on is to teach children financial literacy. And that is also how we are trying to make revenues. So it's not really about the financial tools, like if you want to issue a card to a child and actually charge for those things. But what we'd rather charge our customers for is for parents to actually educate their children. What we're selling and the value is that your child will be smarter with handling money. And there's a big value in that. So we sell that directly to customers as a B2C model. It's just a subscription in the Gimi app. And then we are working with banks so that they can use our platform to use it to their customers. So then the bank pays us a license fee on a yearly basis based on the fact that we are developing a software which they are willing to use.
Fantastic. Well, thank you both very much indeed. I guess a good question to start with is, let's talk about debt. Is it always bad? And if not, under what circumstances is it not bad? And under what circumstances, if any, is it? Stephen, can I put that to you first of all?
Yeah, I think it's a great question. I mean, the short answer is no, debt isn't always bad. I think debt, if you look at what it's intended to do, it's there to provide a bridge, provide a way of getting to an item that you want, be it a house, a car, whatever it might be. And so used in that way and used against those principles, absolutely, it's, debt's a good thing to have. Where debt becomes bad is where it's not serviceable, where the customers can't meet the needs, where they become overburdened with debt. And I think what I've seen in my career, having worked at a range of organisations at both ends of the credit spectrum, if you like, from the granting of credit to the debt collection end of the cycle, is those customers who have got into a bad place. It's multifaceted in terms of why they've got there. It's not just they've taken on a lot of debt. That could be one reason, but a lot of the times it comes back to personal circumstances as well. They could have had a life-changing event, such as they've lost the job, or they've become ill in some ways. But I think there's an interesting part that underpins a lot of this, and I think it's something that Philip's sort of talked about in his introduction. Really, is around that piece about understanding what debt is, understanding what the benefits of it are, which I think are fairly readily available, and that's how sort of credit can be marketed a lot of the time. But actually understanding what it means when it's not affordable, when it becomes a burden, when it becomes a problem. And I think some of the stuff that Philip's talking about in terms of the education right at the very start for kids and all the way up is that financial literacy in terms of understanding what it means to have a level of debt that's serviceable, how you can meet your commitments, how you think about things in terms of where you have life-changing events and what that means. So a long answer, Ben, appreciate that. But in terms of debt isn't always bad, no, but when it becomes bad, it is bad for customers. It can be life-changing, life-destroying in extreme cases. And there's a whole range of reasons why debt then becomes bad for people in society.
Stephen, thanks very much indeed. And I guess, Philip, turning, as Philip's indicated, you're focusing very much on the education piece here. How do you really break this down and make it simple to help people, young people especially, understand when and whether debt is a good thing for them or not?
It's a great question. First of all, if looking at financial well-being and the definition of that, it actually consists of 4 elements. So if we are to have, as an individual, financial well-being, we need to be able to control our daily and monthly expenses. Secondly, we need to be able to absorb a shock in terms of expenses, like when there's something is popping up, which could be really expensive for us. Third thing is that we need to have the freedom to take decisions with our money, which makes us enjoy life. Everyone could really relate to that. It's like, I want to buy an ice cream, or I want to go and travel somewhere. The fourth is about being in line with a long-term goal, meaning that we might want to buy a house in the future, or we might want to be able to build a company, or something that you need a bigger investment for. I would say when it comes to 4th element, it's not possible to reach that without debt. in many ways, we need to get access to money to be able to invest for the future. And as Stephen is talking about, like it's more debt becomes, I would say, worse for the individual when we talk about the daily or monthly expenses, or when we're talking about the possibility to absorb a shock, because that's where we see today that people end up in debt are like feeling worse. They're more stressed about their money. They're not having control over their daily expenses and so forth. But if I would also just put in here, like about children and the next generation, that is a great way for them to learn as they grow up. So if you as a 10-year-old borrow money from your friend, you're starting to learn about it. And maybe you borrow money from your parents and you're not able to pay it back. There needs to be a way to learn from that mistake. Usually what happens is that you don't pay it back. Like you borrow like €1 from your parents, and if you don't pay it back, you're gonna bring in that like that kind of habit as you grow older. So in terms of what children are learning today in terms of debt, they are coming in to the adulthood not prepared in terms of what are the consequences when you can't pay it back, or when you're in really like when in debt and you don't have control over it.
Well, thank you very much indeed, Philip. I guess that advice comes a long way further than another piece of Scandinavian financial advice. Neither a borrower nor a lender be, for loan oft loses both itself and friend, and borrowing dulls the edge of husbandry. So clearly there is a role for debt. So thank you very much indeed for helping to explain it must be in that long-term planning category. I guess you told us a moment ago, Stephen, that you had moved from providing loans yourselves at Think Money to really guiding others around the pitch. So I guess you've moved from being a player in the lending space to being a referee. I'm just curious, how do lending providers make money while keeping the cost of obtaining those loans low for borrowers?
Yeah, it's a good question. But just before I come on to that, Ben, just to pick up on a point that Philip makes, I think it's an excellent point, really, that the whole sort of bit that educates through, I think it's great what Philip's trying to do, you know, through his app and through his company with kids. And I think there's a real important part to that in terms of making children at an early age aware and savvy to what money is, what debt is, how you operate when you move into adulthood, if you like. And all too often I've sort of seen in my career that, you know, you're only as good as the influences and the people you've had around you, really. I mean, you know, from my experience, you know, I learnt a lot through my parents who were quite savvy and very conservative in what they did. I didn't particularly get an awful lot of education at school in terms of what money was and loans and debts particularly. And from what I've seen in my sort of working life, I've seen that those influences around you tend to sort of dictate and sort of influence you quite heavily in terms of how you go about using debt. You know, it's at the extreme. I've seen families sort of generation to generation accept it as the norm that it's okay to default on a loan, and you know it's okay, it's fine. You know, that's what happens, and not understand the consequences of it when that results in legal action. You know, and there's a gap in the understanding there. To the other side, you know, you find some, you know, and again, education in some ways, or having a high-paid job is not always a good barometer for someone been savvy with money. You know, again, I've come across people in my career, again, not many, admittedly, but who have very high-paid jobs, but have no idea of how to manage funds and cash and understand what debt is and the impact of it. So I do think, you know, what Philip's doing in terms of, you know, starting at that grassroots level and bringing it through is wonderful. But I think there's a real big piece here for us in financial services to sort of really build on what's been happening over the last generation, probably, in terms of let's really understand what causes bad debt. Let's help with understanding, and you know, and when is debt good. So I'd come back to your question that you asked me, just to sort of come back to that, you know, in terms of, you know, how do lending providers make money while keeping the costs low? I think I'd probably take a step back. I think the last 10 years in particular, we've seen a real advent, you know, it's almost like a real step change in terms of how technology and how firms provide funding or loans or credit in general to consumers. It's not just the sole domains of banks anymore or credit card companies. You see lots of other finance being available through different firms, and the latest one being sort of the buy now pay later through firms such as Klarna. And again, you sort of seeing that real accessibility, making it very easy. We have a very strong culture, particularly in the Western world, where there's high technology of wanting stuff immediately, and credit has become very much that way. I think the way that firms sort of make money generally in that way is a bit of through volume. I'll sell a lot of it. I'll keep my margins low, and I'll make my money that way. And you tend to find that the shorter the term, the higher the rate on it, because the pricing and the risk around it. And I think that's always been the case. I think the old-fashioned way or the traditional way of pricing loans in terms of the interest rate I charge is based on what I expect to default and covering my overheads, that way still exists. But I think because people want stuff immediately and can get credit really quickly, you sort of find that the price for very short-term loans is very high, hence why you've sort of seen high-cost short-term credit sort of be very popular for a while. That seems to be falling back now. I know you're seeing things like, say the buy now, pay later becoming increasingly popular as well. It's very easy to access funds. It's a small amount as well. So that's how I sort of see it. I think technology really helps keep the costs down. You don't need an army of people to underwrite lending like you used to do. When I first started working, you have people who just do it manually. It's very automated. It's very much based on analytics and data. And it's also based on where a company's risk profile and risk appetite is in terms of how much they want to predict in terms of losses they want to make and where they want to be. That's how they think about it, which is fine. I think where the challenge is, and this is where you get sort of the, coming up against the regulator, and quite rightly so, is it's that sort of softer stuff, that more qualitative stuff around what are people's circumstances. And perhaps to where Philip's mind is as well, and I wouldn't necessarily disagree with him, is that what's the aptitude and the understanding of debt and credit, and what does it mean? I think, just sort of digressing slightly, in mortgage lending, you've sort of seen that shift in the last sort of 10 years with real in-depth understanding of circumstances for a 20, 25, 30-year loan to understand what all eventualities that could take place. And while I'm not suggesting that needs to take place for a small ticket loan, the principles of that in terms of understanding and there's probably an increasingly need to have that understanding there of customers and what they do. And again, maybe facilities such as open banking and open finance, where you get to understand how a customer behaves, actually provides that insight in a very seamless and understandable way without creating extra burden in terms of the customer journey and extra burden for firms who provide the loans, because the prices will go up that way.
Stephen, thank you very much indeed. Well, you've covered a lot there, and I think perhaps we can unpack some of that in a few moments, including, for example, the move towards more short-term, immediate borrowing. And Philip's already highlighted that actually we should be taking perhaps a longer view on that. Just to summarize briefly, though, a key point I think that you made there was that there is a real proliferation of lending providers, and clearly there are advantages in terms of cost for offering longer term loans. And so you've highlighted the fact that many of us are drawn towards shorter term borrowing, and that comes with a real cost penalty. So I guess that perhaps cues the way to a question really for you, Philip, about how we balance easy access to credit lending with healthy financial wellness.
Yeah, I would say we don't, because the human mind is lazy. So if you want to buy something and someone is like asking you, how do you want to pay for it? And then they also say like, hey, you don't even have to add your credit card here, because you can just push a button and we saved your data, your personal data. And then we just, in a month or so, we send you the invoice for it. So our lazy minds will have a big problem as like credit becomes way more accessible. And maybe just to go back to one of the things Stephen said was like, how could this be possible? And how can like lenders make money out of this when they keep the cost so low? So it's about volume, as Stephen said. And if you just look at like Klarna, for instance, if you look at where they make their revenues, 3/3 of it comes from commissions. Like the number of times that people are taking these credits, it's 1/4 is about the interest rate, and the interest rate has also in many ways been regulated, so that we don't like pay enormous amounts of interest rate, even though they're high sometimes. So where am I going with this? I'm going where, if you can just like look at what David Sandström, like the chief marketer at Klarna, said the other day when they did like the Super Bowl commercial. He said that now Klarna wants to be part of the shopping experience. He wants it to be the shopping experience. So if we go back 10 years in time, when we wanted to lend money, we had to go to the lender, or we had to take an SMS loan or something like that. That was its own experience. Today, everything is packed in the shopping experience. So if you ask like, okay, how do you tell a person that want to buy something, and they can do it with one click, that they, should make those decisions not to? Like, if we just look at the consumption today, like in Sweden alone, like how Swedes are consuming, it's 4 times the Earth's resources every year. So the consequences of the consumptions will affect like the planet, and that it's like, if we're talking about well-being, we need to start thinking about the consumption, which is very correlated to credits, because we're spending more money that we're having. So that's more like on a broader level. On the society level, in Sweden alone, it costs somewhere around 5 billion euros every year for the people that end up insolvent, like people that are able to pay their bills. If we look at the next generation that's been growing, that grows up today, between 2018 and 2019, there was a 40% increase of 18 to 20 years olds ended up at the enforcement agency, not being able to pay their bills. So how can it be such a big increase? It's easy. It's about the access to credits and the understanding of what happens if I'm using credits and spend money that I actually don't have. And I could go on like for an hour about this, but where it gets complex and where it like really strikes an individual in many, like in a worst case, is that the children that are growing up and become adults, the ones that have rich parents, they're going to be okay, because the parents will pay them out from the enforcement agency. The ones that are going to be hit worse is like, if we would call it the B team, the one that doesn't have that much money, like immigrants. When I talk to enforcement agencies, it's the immigrants that end up in the enforcement agency and keep on being there. And it's very correlated to the education. So they are actually doing statistics, and they can see, okay, most people that end up at the enforcement agency have a harder time to understand what interest rate is. And the people that are better educated, they understand that, and they don't end up at the enforcement agency that much. So I don't know if I can summarize it, but I hope you get the point.
Well, very much so. Thank you. And in fact, both of you have highlighted the extent to which much of this is inherited, and that the experiences you grow up experiencing in your family can shape your own experience later. So I'm curious, with both those precarious immigrant populations and those people who've grown up in financial insecurity and instability, what kind of educational interventions can really make a difference? And I guess, Philip, if I can take that question first to you.
Yeah, we just look at how children learn about money. There are 3 ways. The first one is that you use your own money and you learn from your mistakes. It's called learning by doing. I think everyone understands it. Today, unfortunately, most children don't have access to a bank account. The most like normal way for a child to pay for something is that they don't pay for it. They actually borrow their parents' card, or the parents are paying for them. There's no room for any learning experiences. The second way for a child to learn about money is know-how. It's like the basic thing, like you need to read some theory in school or something like that. Biggest problem there, which OECD is also pointing out, is that we don't have personal finance as part of the curriculum in any country in the world as of today. So what we teach children is like molecules, history, languages, but we don't seem to think that personal finance is of that importance that we should teach it. The third way for children to learn about money is called socialization. And it's just the way that you look at someone else and how they behave with money, and then you copy it. Or you discuss with someone else and you learn from it. And socialization is the most used way for children today to learn. And that's why money understanding is inherited, because children are looking at their parents and they try to understand how they're doing it. And they look and then they do the same kind of behavior. The problem is that today there has been financial literacy tests on adults. Around 50% of adults today are financially illiterate. So, of course, the ones that are financially literate will, by most chance, have a child growing up financially literate. So there has to be ways to teach know-how in schools, and there has to be ways to financially include children using their own money. And there I would like to point out, banks need to take way more responsibility here. They are creating payment tools and they're optimizing it, and they're doing a lot of things for grown-up people. I don't know one bank in the world that has a child-adapted app. I don't understand it. Secondly, I would say we need to address politicians in terms of them taking the decisions to add personal finance in schools. If we don't do these two things, we will see more young people ending up insolvent. We will see a lower financial well-being for the next generation as they grow up. And we're probably going to see more financial crisis, I would say.
Well, you paint a powerful picture there, Philip, and clearly not only an educational need, but also a political imperative and a need for the banks to take responsibility too. So, Stephen, on that note, when it comes to regulation, there's a lot of criticism coming towards the buy now, pay later sector at the moment, and talk of regulation. What should the regulator do to keep up with the proliferating forms of credit that are increasingly available?
Yeah, don't get it. I think Philip makes some very powerful points there, and I think it's easy said, but a complex problem with, and I don't think there's any one solution to the underlying problem. I think that there's lots of little things. I think in fairness and in defence of the banks, if I just tap before I come to your main point, Ben, I do think they have moved with the times. I think they have done a lot, and I think particularly with their customers in terms of trying to educate them. And I think some of the stuff that they've possibly been led by the regulator around sort of conduct risk issues and thinking about financial literacy. I think most organisations would always say they've got more to do. And I don't think that's new news to anybody. I think in terms of the regulator, I think the regulator's in particularly in the UK, I think is in an interesting position, and one I have a lot of empathy for. In that, if you sort of take a brief history lesson, they were a sole regulator up until sort of 2013, and then broke into the FCA and the PRA. The FCA with a strong focus on, and a primary focus on conduct risk, how firms conduct themselves because of the range of issues that had been in the financial services sector in the UK, not just lending related. But then you sort of get into that sort of for the regulator. They're dealing with sort of the bread and butter and the complexities of businesses. And then what's happened is they've sort of taken on another load of businesses that were regulated by the OFT that's different again. So they've probably got 55,000-ish businesses that they regulate. And then what you find on top of that is that there's almost like another industrial revolution, if I could term it that way, where you've had a massive step change in terms of technology and how that comes along, and then how finance is available to individuals. And in fairness to the regulator, they're always playing catch up. I think the regulator plays a good role. I think they're one of the strongest in the world, no doubt about it. I think they're learning very, very quickly in terms of what to do. And I think the fact that the Woolard report that was recently issued, which talks about the problems of debt and talks about where problems arise from, and also talks about the emergence of buy now, pay later, shows that they recognise the issue there, how corrosive it can be when not used correctly, but also how they think about having a common playing field in terms of let's have regulation. If we're going to regulate high cost short term credit, if then why wouldn't we regulate buy now pay later? Because people will just migrate to places where they can get credit. So you'd want, as a regulator, to have that very sort of pan financial services view and having a level playing field there, not create any unfair competition or unfair practices. So I think the regulator's got a tough job, no doubt about it. I think they've done a fairly good job over the time in terms of how they've had to work with the financial services industry and the pressure that's on them. But I think, like most sort of countries around the world, it moves very, very quickly, and I think it's because of that. The challenge it's not easy to address. I think education, to Philip's point, is a big part. But I think there's a lack there in terms of we've got people now who've come out of school who do have bank accounts, who do have credit, and how do we address those? How do we deal with that? How do we reduce that impact? How do we bring that education there? And that's not just the role of a regulator. That's a society issue as well.
Thank you very much. And I guess you've highlighted and I think celebrated the role of the regulator. Of course, former regulator, now at the board of the Bank of England, is Andrew Bailey, who a long time ago singled out free banking as a source of some of the problems associated with punitive borrowing rates. And I'm curious to know, from a think money point of view, what your view is both on free banking and critically also the extent to which responsibility lies with the consumer.
I think in terms of free banking, I think it's what do we mean by free banking? I mean, as I said right at the very start, was at Think Money we charge, there's a fee associated with our account depending on which type of account you take, and we package up the current account plus with a number of other features and benefits that help our customers. There's definitely a movement, and certainly over the last few years, there's definitely been a movement towards more of that. And I think, just digressing slightly, you can see some of the new entrants, the new challenger banks, if you like, certainly looking at how they can improve their revenue lines by moving towards a fee-based account model along the way. I think, free banking, has there ever been free banking? I think for those customers who conduct their account, as in don't go overdrawn, run it very, very safely, that's yes, there's probably an argument to say there's free banking there. But for many other customers who use overdrafts, who go overdrawn, who experience unpaid items, it's not free banking. You're paying a charge for it, and quite a hefty charge usually along the way. So I think we've got to be careful what we mean by free banking. Just because you don't pay for the current account, you might pay in other ways depending on how you conduct your account. And then there becomes a point, and maybe it's more of a historic point now, I'd like to think so anywhere, is where you're looking at the behaviour of that customer account, and then you're working out what that customer can afford in terms of pre-arranged overdraft, pre-arranged credit card limits, pre-arranged personal loans, whatever it might be. And that then sort of potentially gets into that spiral of, I can get access to credit, I can do it, I'm pre-approved because I've been assessed based on how I conduct my account in terms of what I can do. And that underlying behaviour, if I go overdrawn, for example, and the items returned, doesn't really go away in some instances. Again, not all, I'm talking probably at the extreme for these, but it's that type of behaviour. So I think, I'm a great believer in that, understanding customer behaviour, data analytics, and using that in a positive way to understand where vulnerability is and how you can help customers and give them access to the best products and actually help them along the way is a great way where I sort of see the next development in terms of where financial services go. I think that to me is the next part of it, and organisations that lend, particularly banks in the first instance, that's where they've got the power to be able to shape and say, right, let's look at what's right for you. We understand how you run your account.
Well, thank you very much indeed. And I guess we're running short of time. So just to draw this to a close, I'd like to ask each of you in turn. Philip, starting with you, what would you like to see come about in the lending environment over the next few years? What do you think is the best we can aim for and hope for?
Well, obviously, I would like to see more educating from the organizations, but maybe as well also the providers. I mean, there are ways we can educate our customers, and I think there is a big value in that. If you're working in this space, think about the value you can bring to a person by educating them about like the interest rate or how they can pay the loan back, or just like good information. And well, just like looking at children growing up today, I think like everything is online, everything will be instantly accessible, and I'm certain that loans will be as well. But the thing is that if everything is going to be that instant accessible, I don't think regulators will be able to push back that I would say like user-driven behavior. There's not a chance like children like playing with V-Bucks in Fortnite, that when they go and become 18, 19, that there's going to be really hard for them to get a loan. It will be about like other, like probably how the companies that do lend money can make their product better for the users. And I think education is a great way. I do think that there is a big value in being a company with a mission, and that I see how users change their, I would say, what they think is important for companies. Like Klarna, for instance, they're working really hard to make sure that the loans they are giving out, the credits they are giving out, is being paid back. And I would say that's not about the regulators, it's about the users. It's about they building the brand which people want to identify themselves with. So I do think that providers will change a bit, and they will value that customers want to take a loan from a brand they like, and that will be about a good mission and education and those things.
Brilliant. Thank you very much indeed. And Stephen, your last thoughts on what you would like the future to hold when it comes to the lending environment.
I probably echo a lot of what Philip said in terms of the education point. Certainly, I think that's the place to start with and go. But I think there's society issues that need addressing, which education covers part of. I probably come back to the point that I made previously, is that as we're sort of going through this technological sort of revolution and advancement, and it's quite a step change over the last few years. And I think there's indications that this is doable, and it's starting to come through. Perhaps not as mature as it needs to be, but I think the use of data, and in particular tools like open banking, open financing, taking a more holistic view of a customer and what they're all about, and also having a long-term relationship with an individual rather than a very much a transactional short-term relationship with an individual, to help them with the good times and the bad times that everybody experiences, some more pronounced than others. I think that's got to be the way forward. And how do we use that intelligence that we have as firms within financial services, the wealth of data that's available to understand, to really sort of, while the education lag comes through and people sort of build their knowledge up, how do we sort of push it along in a positive way in terms of that understanding of customer behaviour, what it means to a specific customer, how we can preempt serious debt problems. I think that to me is a very, very doable solution, and in many ways it's starting to come through now. But I think maturing that would be absolutely, where most organisations would be aiming for, and certainly as an industry we should be aiming for.
Stephen and Philip, thank you both very much indeed. There we have it. I think a long-term view, collaboration between regulators, practitioners, and consumers and educators, and of course, education. Thank you very much indeed to both of you as panelists, and thank you for joining us for this session.